Welcome, everyone. I'm with two of my esteemed colleagues, Laura Culp, who is a tax expert, but she's also part of our wealth management team. So she's here today, and she'll talk about some of the some wealth management, retirement plan topics. Jim Brandenburg, who I think most of you know, and we've got this, you might have read about it, we've got this tax legislation that is making its way through Congress, or proposed legislation, but a long way to go. And so we'll talk about the expiration and then potentially what we might see this year based on what we know today. And then, sorry, I'm having a little trouble here. Here we go, advancing the slides. And then we'll talk about a few developments at the end. So a few housekeeping items. Please put your questions in the question feature of the panel. There is a PDF copy of the slides available. And if you'd like to receive CPE credit, we'll need you to answer the polling questions and then a brief survey at the end. And then you should get certificates within 2 to 3 weeks. Hopefully your CPE certificates will come in. So anyway, with that, I'm going to jump right in here, and we'll go to the next slide. So I've kind of covered the main topics today, the 25 tax legislation and kind of current status of that. There's a few Secure 2.0 provisions that go into effect this year, so we'll cover some of those. Estate taxes and some of the uncertainty around that with the sunset of TCJA, and then cover some recent IRS developments and some recent rulings and so forth. So that's our agenda for today. And again, thank you all for being here. And I will turn it over to Jim Brandenburg.
Good. Good morning. Thank you, Tom. Thanks, Laura. And good morning, everyone. Again, we've got a lot to cover here, so we'll get started here. Again, a lot on this 2025 tax legislation that is out there currently going through Congress. And just a brief background on it. Again, we have touched on this, but just to kind of get everybody on the same page here with it, this TCJA, the Tax Cuts and Jobs Act, was passed back in President Trump's first term back in December of 2017. And this was a comprehensive across-the-board tax cut, $1.5 trillion, again, applying to businesses, individuals, small or large. It had some simplifications, but also a number of complex items that were put in there. Unfortunately, for a number of taxpayers and practitioners, these changes were not permanent with it, and they're set to expire at the end of this year, and going back to the law essentially that was in place before then. So we're going to go through that in a bit, and then we're going to talk a little bit, and I think it's important to have a little understanding on this budget reconciliation process that is being used by Congress with these tax bills. Next slide here. Okay, here's some of the ones that most of these are individual provisions that are going to expire at the end of this year. The individual tax rates, again, 5 of the 7 brackets were cut in the TCJA. Those are, again, if nothing happens, they're going to go and will increase next year. This 20% qualified business income deduction, again, applies to pass-through businesses. 20%, that actually drops the top rate on these flow-through businesses down to just under 30% from 37%. Again, a lot of complexities, but a lot of benefit for some businesses have taken advantage of that. That will expire next year. The standard deduction, which had doubled, that will go back to what it was before. The child tax credit was at $1,000, it was up to $2,000. That will be reduced. The SALT tax deduction, there was a limit that was put in of $10,000. We'll talk about that in a little bit. Again, that limit is actually going to go away next year, scheduled to. And then the last thing is the state and gift tax. The exemption with that was doubled essentially with the TCJA. That's actually scheduled to scale back. We're going to talk about that a little later on with it. So these are just, again, some of the selected items, again, mostly individual ones that are set to expire at the end of this year. Here's a few provisions just to note that are not scheduled to sunset. And some folks that don't recall this, but the corporate tax rates, which again were cut from 34% down to 21%, those are not set to change. Those are going to stay at 21%. These three business provisions, the bonus depreciation, the R&D expenses, and interest expense, those actually changes came in back in 2022 and 23. And actually, those are applying right now, and those are permanent changes. So we'll talk on that later on. Those are affecting a lot of businesses over the last couple of years. As I mentioned before, what was used, when TCJA was passed and what is in place now is what they call this budget reconciliation or reconciliation. And again, it's a special provision in Congress where they're able to pass a bill. And again, the party, in this case, the Republicans, are in control of Congress, both the House, the Senate, and the White House. So they can pass legislation with only majority in the House and the Senate. So they only need 50 votes in the Senate instead of normally 60 votes to stop a filibuster. And that's key with this bill here. And the Republicans have already started on this path to use the reconciliation for their tax bill for this year. Again, they have slim margins in both the House and the Senate, so that's going to make it a challenge with it. This reconciliation, just to point out, is a two-step process. First, the House and Senate leaders adopt what they call a budget resolution that indicates the amount of the tax cuts, and so what they call the instructions for the committees. That's got to go through the same one, go through the House and the Senate. Then after that, the second step is where they actually write the legislation, and that happens later where the tax writing committees and some of the other committees in Congress write the rest of the bill. And that's where the Ways and Means Committee and the Senate Finance Committee get involved and write the legislation within the framework of what's in that budget resolution. So this is, again, a more involved process to pass legislation than other bills have.
And by the way, this is really how most major legislation has passed, really since the Affordable Care Act was passed by President Obama, and maybe even before that.
Yeah, even before, I think you're right. Yeah. And again, both parties have used it with it when they get in that position of having control of Congress and the White House. Again, one thing to just keep in mind, some folks say, well, we're just going to wait, and see what happens this year. Well, no, if nothing happens this year, if Congress doesn't get a bill with it, then something is going to happen next year. Okay, the rates are going to go up. Some of those changes we just mentioned there, those are going to go into effect, and you're going to have higher individual taxes. You're going to have that QBI deduction go away. The estate's going to go up. So to keep the status quo in effect, we need to have a tax bill. Okay, so just keep that in mind. It's a little different dynamic this year with it. Again, the centerpiece of the legislation this year is going to be the TCJA provisions that are set to sunset at the end of the year here. So those are going to be, a cornerstone, if you will, of this legislation. So we really broke it down and to kind of give a little overview of what may be in this legislation. There's 4 areas. Again, the first is the extension of the TCJA tax cuts. The other thing is some of the campaign themes that came up in this last year's campaign. Some other proposals that may end up in there, and then some what they call offsets or pay for, some items that actually could be some net tax increases to help pay for some of these tax cuts that will be in the bill. First, the extension of the tax cuts. Again, we talked about that. Again, the individual rates, again, those are going to be a key part of it. Some items, however, it's going to be uncertain. Again, we just mentioned before this $10,000 state and local, the SALT cap limit, again, that started in effect in 2018. Again, many legislators in both sides really that are in these higher tax states have, since this bill was passed back in 2017, have pushed hard and advocated to get rid of that limitation or repeal it or to raise that $10,000. Some other members in Congress, however, want to keep that. So there'll be some debate with that, definitely. And that will be something that, again, once they get a budget resolution set and they actually start drafting the legislation, that's where this will be a key point. Speculation is, though, that $10,000 limit will be raised. It's probably going to be $20,000 or more. I don't see it being repealed outright, but will probably be increased somewhere in the $20,000 to maybe $40,000 range. So that's something we'll keep an eye on. And again, there's some in some of these higher tax states that are watching this very closely.
Jim, if they do raise that limit, I think more people are going to find themselves subject to ultra minimum tax. So we'll have to worry about that a little bit more too.
Yes. And that's one that the two is one of the ones we didn't have on there as far as one of the ones that expire at the end of the year is the AMT. A lot of the provisions in there were expanded. The TCJA. It
The
expected those.
limit was increased, yeah, and so a lot of taxpayers weren't subject to it, and that
Right.
could expire, which again, to your point, Laura, means that maybe more taxpayers would be subject to AMT. So it's a great point, one I'm glad we brought up here.
Yeah. So we got to watch the what that salt limit is and what AMT changes are when they get down there. Good. Some of these business provisions I mentioned before, these 301, the research expense amortization, the bonus depreciation, 100% bonus and interest expense limitation, which is affecting a lot of businesses. A lot of business groups over the last several years have lobbied Congress hard. A year ago, they had a bill actually that went through the House and stalled out the Senate that would have softened those provisions. And both the both the tax writing committees realize this and expect these items to be reinstated to their prior favorable treatment. Um, the interesting part with that is even if you do get the research expense amortization and get current deduction and bonus 100% bonus to come back, the question is what's uncertain though is what the effective date would be on these changes. Would it just start in 26? Might it be sometime in 25 or maybe, some think maybe 24? And then will there be some type of catch-up adjustment for some of the prior amounts that you weren't able to deduct the last couple of years? Would you be allowed to get that or not? So that's where a lot of the uncertainty lies is with these three items is not only will they likely be reinstated, but what would the effective date or any transition relief be? And again, once they start writing the legislation, we'll get some of the specifics on that provision. So something to keep our eye on. And again, I think it's probably at least a couple weeks out before we start hearing some of the details of that. Next slide here. Next, we're going to go to from some of the TCJA things to some of the campaign themes in 2024 campaign that we heard last year. And again, these were pushed hard with it, and it's likely that these are going to end up in the bill in some capacity with it. Again, that's what key members of these tax writing committees are going to have to come up with. The first one is you've heard this no tax on tips. Tip income would be excluded from income. The idea, was sort of targeted or geared toward the restaurant and hospitality industries. Again, it's unclear if that would just be the income tax or it also extend to Social Security taxes, what reporting would be required with it. Again, some of the details of this remain to be seen as to how that's going to work, but it is likely that this will be in the bill, or if there will be a cap on this, again, this would be in the bill in some fashion. Next one, another one is this no tax on overtime pay. That was also brought up. Again, what industries are going to apply to, whether it be a dollar limit, a cap on it, how that's going to play out with it. Will some people who are maybe salaried and don't get anything for overtime, might they switch to be an hourly worker? Again, once we get some of the details on that, then we'll find, how that will apply both for the affected workers, but also for employers and how to deal with that. Another theme that came up with is no tax on Social Security benefits. The amounts would not be taxed. Now there's a sliding scale based on your income. The Social Security is subject to income tax. This provision, however, we talked about the reconciliation before. There's really some real detailed rules with reconciliation. In some cases, you've got to look at those rules and they will let you know what can be included in a tax bill and what can't be. And there are some rules with the budget reconciliation that limits changes with Social Security. So it'll be interesting to see if they were able to incorporate this into a bill or perhaps have to do a separate bill outside of this tax bill in reconciliation to do something with Social Security benefits.
Yeah, Jim, on the tips, it's interesting that one of the initial drafts had somewhat specifically defined which trades, if you will,
Right.
could use that, and hair salons and barbers, I remember, was one of the things one of the trades that that would be eligible for that. So I think they're trying to be very specific in that legislation as to who it would apply to.
Correct. Yeah, it'll be interesting to see how that plays out, and then whether, again, when any of these changes happen, our state's going to follow suit with that as well. So we'll have to see. Here's a corporate item. Again, as we mentioned before, the corporate rate was cut to 21%. Again, that's not scheduled to change, but the president has indicated that might even cut that further down to 15%. Okay, and but that would only apply to those the companies that make their products in the U.S. Okay, again, how that's going to be defined, and again, described with it, it remains to be seen. But again, that's quite a low tax rate to get it down to 15% with it. But again, the idea is to encourage investment and production here in the U.S. So that's something that we'll see if that ends up in the bill as well.
Okay, I think we got our Jim. We got our first poll question here. You want to read that?
Okay, if this corporate tax rate is lowered to 15% as part of this tax bill, would you consider changing your entity status? So just kind of a off the cuff response here. Yes, no, or not applicable here. We're getting the votes coming in here. Pretty much across the board here. We'll keep this open for a moment here. Got almost everybody voted here. Okay, well, let's close the poll down here. Okay, we've got 37% yes, they would consider that. 27% no, and again, 36, the rest, it didn't apply to them. So again, pretty interesting that we get quite a contrast here to switch that. So again, we'll see whether that makes it and what the specific provisions are with that. So thank you very much. Next slide here. Some other proposals here, again, are, again, these aren't ones with the TCJA or some campaign themes, but have been brought up, over the last year or so, and may end up in the bill. One is this Section 1202, this qualified small business stock. We'll talk about another slide coming up here in this. To expand that, that's available for some businesses that may be expanded. Some proposals out on that. The estate tax, so Laura's gonna talk about that later, but we talk about the exemption being higher. There's also a move with some key congressional leaders to repeal the estate tax in total with it. So that may end up in the bill, depending again on what ends up, how much they were able to include as far as tax cuts. HSAs and other universal savings type accounts, there seems to be growing sentiment or some support to expand the use of those type of investment accounts that allow people to save for certain things. We've seen some proposals, some changes with it, and perhaps expanding on that. And then another one is charitable contributions for non-itemized. As we had some of that during COVID, some of you may recall that. Again, with the higher standard deduction, some folks are still making charitable contributions that would allow them to do this up to a certain level. Some say maybe $1,000, or another proposal said they could take like 1/3 of the standard deduction they could make for charitable. So something we'll keep our eye on with that as far as some of these other proposals. As I mentioned for the Section 1202, there's this bill that was recently introduced a couple of weeks ago. The Small Business Investment Act would expand the Section 1202 as far as the eligibility and benefit. Again, what this 1202 allows is for the shareholders who invest in companies that meet the qualifications for it, they can get 100% exclusion on a gain with that if they hold it for a 5-year period. This bill that was introduced here got a lot of support from the Chamber of Commerce and some venture capital groups and others. But it would also have sort of a sliding scale with it. Next slide here, Tom. That it wouldn't have to be the full 5 years. You could get some relief after 3 years or 4 years with it, which would be attractive. The other thing they're looking to do is have some features with some convertible debt. And the last thing that's been an interesting one, just to point out with this, if this does move forward, is this 1202 was only available for C corporation stock. S corporations didn't have that availability. it would be expanded to include S corporations with it. So something to keep our eye on with it. This could be folded into the bill as well.
Yeah, and it's we see this a lot with startup companies. Obviously, there's other eligibility requirements, but this is really something to watch because it's a fairly powerful uh, area in the tax code, and especially if we see, as you mentioned earlier, Jim, rates for C corps go down from
Right.
potentially 21 to 15, operating as a C corp becomes even more attractive, especially in light of potentially being eligible for this qualified small business stock exemption. So it's a pretty interesting proposal that we'll want to kind of track.
Right. Right. Thanks. That's a great point, Tom. And last is some of these pay for, some offsets that, again, the TCJA had some of those provisions, and it could likely end up in this one. We just have a couple listed here. Again, there could obviously be other ones. These pay fors, one is carried interest that's been around the last number of years that there's been proposals to scale back on the carried interest that's used with some private equity and other investment ones to get some more favorable capital gain treatment instead of ordinary income. But that's something that the administration has voiced some support for, so you might see that in there. Another one is excise tax on endowment funds at large colleges and universities. They have significant amounts in those funds, and Congress, some members of Congress feel that they should direct some of those endowments funds toward tuition relief and scholarship for some of the students. And if they don't do that, they could be hit with some higher excise tax or penalty taxes with it. So that's one area that some of these colleges and universities could have. There's a bill here that was introduced, this Endowment Tax Fairness Act that came out about a month ago that would increase the rate on that excise tax up to 21%. We got some of the requirements here with it. So anyway, the effective date with this, at least this proposal here, would be for tax years beginning after enactment. So let's say if there's a tax bill this year, it would start next year. But again, the specific details, the House Ways and Means and the Senate Finance would do, but something to keep an eye on as far as a potential pay for in the bill. So now we got the status of the bill, this called the Road to Reconciliation. Again, the same resolution must pass in the House and the Senate, and it provides this framework for the rest of the legislation to be drafted later then by the various committees. Again, those committees would be the for the tax ones, the House Ways and Means and Senate Finance. They deal with the tax bills. Again, there are two approaches, however, that are being pursued, at least over the last couple of weeks. The House had one plan, the Senate had a different one. And again, eventually the same resolution must pass in each chamber. Next slide here. The Senate plan, is maybe as some of you have seen this or followed it, had this two reconciliations. They were going to do one bill that had border and energy, and then a second one that was going to deal with some of the tax matters. They thought that would be a good way to get it through there. They passed their first one last week, last Friday. The House plan, however, is a much larger one that's going to have all these issues. It's going to have border security, defense, energy, but also the tax provisions. This is this big, beautiful bill that the president has referred to. The Budget Committee passed this last week, and the full House actually passed this on Tuesday night, narrow vote. And this resolution, again, had $4.5 trillion of net tax cuts in it and spending reductions of about $2 trillion with it. That was, again, not any specifics with it, but those were just some of the framework of the resolution. So now the House and Senate leaders need to really decide, what are they going to do? They could just take up this House resolution and, vote on it, perhaps in the Senate. Again, if they make any changes to it, it needs to go back again and pass in the House with it. Or they could do what they call a conference where leaders from the House and Senate will get together and kind of put this resolution together. Then it's got to go back to each chamber and pass with it. So I think over the next several days, they're going to, decide which course they're going to take with this. Again, they need to have the exact same resolution passing the vote. And the other thing that, as far as the timing with it, they like to get this done, but I think it's March 14th. They have the debt ceiling has to get extended, and that's going to take some time with Congress too. So those are going to be two items that are going to take the most time and effort of Congress over the next really 2 weeks here. So anyway, that was a big vote on Tuesday night with the House with it, but it's a long way to go here with this reconciliation with the tax bill. So we go to our second poll question here. We mentioned before these TCJA items. Which tax provision from the TCJA would you like to see reinstated? Again, we got the 100% bonus depreciation, the immediate expense of R&D cost, and the revision to the interest expense deduction limit. So go ahead and offer your vote here. And again, these probably all will be reinstated if any of them are, but again, some impact more businesses more than others. Okay, we're almost got everybody voted here. Okay. Okay, the 100% bonus depreciation looks like at the top 53%, a little more than half there. We got 31% with the R&D, and then the interest expense changes about 16%. So thank you for your input with it. We'll see what happens with that. And again, not only what those changes are, but also what the transition relief is on that. So.
Okay, so I am going to focus on Secure 2.0 and the impact on currently for the next few years. So the first provision is a catch-up provision. So those of you who are 50 or older know that you can do a catch-up contribution to your retirement plans. But for this year, there's a special, they call it a super catch-up limit for plan participants who reach age 60 to 63. And for all plans like 401ks, excuse me, other than simple plans, it's 150% of last year's limitation. So the new limit is $11,250, a very significant increase. For simple plans, that increased limit is 150% of the 2025 limit, which increases it from $3,500 to $5,250. I should note that the regular catch-up limits did not change between 24 and 25. So for those of us that aren't subject to the super catch-up, the annual catch-up remains at $7,000 for benefit for retirement plans and $1,000 for IRA plans. The IRA catch-up was amended under Secure 2.0 to include an annual cost of living adjustment, but that did not change for 2025. Next slide, please. So for simple plans, there is a additional provision for employers who have 25 or fewer employees. So for those employees, again, that are not the 60 to 63, they could apply a higher catch-up of 110% of the 2024 limit, which would result in a modest increase from $3,500 to $3,850. And employers with more than 25 employees can elect to apply that limit. Next slide, please. So there we go. Thanks, Tom. So now this Roth catch-up requirements for retirement plans was supposed to apply for this year, but it got deferred until 1/1/26. So this will apply next year. And this is requiring retirement plans that have that allow catch-up contributions, which are most retirement plans, that if the employee prior year FICA wages exceeded $145,000, that their catch-up contributions must be designated as Roth contributions. It doesn't apply to SEPs or simple IRAs. Next slide.
Laura, does the catch-up contribution provision, does that require a plan document revision, amendment, if you will, to have that provision, or can you just automatically do that? Do you
Actually,
know?
I'm gonna address that in just a minute because it's talked about in the proposed regs, but that's okay. But one thing so here we go. So on the proposed regs, they have clarified that the super catch-up is an optional plan design, just for example. And then they also clarified that only FICA wages count towards 145 threshold, and also you don't have to include wages from different employers. So go to the next slide here, Tom. I think this will answer your question.
Okay.
So employers plans that don't offer a Roth the option aren't required to add that feature to their plan. So yes, they're supposed to make an amendment. But if they don't offer the Roth option, then the higher earners get precluded from making any catch-up contributions. The lower earners are allowed to continue to make catch-up contributions on a pre-tax basis. So in essence, most employers are going to be pushed by their employees to implement the Roth provisions, not conversions, the Roth provisions. And these proposed regulations apply to contributions in taxable years beginning 6 months after publication. So right now, comments were to be received by March 14th, and there's a public hearing on this on April 7th. So I do advise employers to consult with our Sikich retirement specialists or their retirement advisors about implementation of these provisions, since they will apply for next year. So now
It's
we're
a
going to go
lot.
on. It's a lot. It is a lot. Well, the Secure Act, as we know, the Secure Acts in general are a lot, and they've had a big impact on retirement plans and RMDs. But we're not going to go into everything. We don't have time today for that. But anyway, one really great, if you can implement it, retirement plan is a cash balance plan. And this works better for smaller employers. So there's 2 questions to consider if you want to look at a cash balance plan. Are you a small business owner looking to accelerate your savings for retirement, or are you looking for larger tax deductions for you, your partners, or your business? Because it allows the plan to benefit the owners and highly compensated people a little bit more than the traditional plan. And
Right.
it is considered a hybrid plan. It's a combination of defined benefit and with the flexibility of like a defined contribution plan, like a 401k plan. Our colleague, Marie Marks, has a recent article about cash balance plans on our Sikich website. And our Sikich Wealth Management specialist can help you review your plans to determine if there's better options, like a cash balance plan or other plan modifications that can benefit you and your employees. And I did a couple years back, Marie did talk to one of my clients about a cash balance plan. It wasn't going to work for that particular one, was not going to work for them, but she did help them modify their plan so they could achieve some of their goals for their highly compensated, very valuable employees. So with that, we've got a poll question, I believe.
Yeah, we do, and it's really a great sort of retirement plan option. You want to go ahead and read that
Sure.
poll question?
Sure, I can do that.
Yeah.
How familiar are you with the benefits of a cash balance plan? Very familiar, somewhat familiar, first time I've heard of this plan.
Good. Interesting responses here with this poll
That's
question.
what I was thinking too. I was thinking the same thing.
Yeah, it's an interesting, I would say in the last, 5 to 10 years, I've become more and more familiar with the concept, and it's really a great planning opportunity, especially when you have, sort of a lot of income being thrown off. As Laura said, small businesses, not always, but in a general sense, small businesses seem to be a good fit for it. But it's worth
That's
a
supposed
look
to be a
regardless.
result. Interesting.
Yeah,
Yeah,
yeah.
so you
Laura,
can
you
see,
want
look at
to?
that.
Yeah,
Yeah, so
go
you can
ahead.
see that the first time I've heard is winning here with somewhat familiar 43. What I will say about this plan, it's used by a lot of professionals like doctors' offices, smaller law firms. That's where you traditionally saw it in the past, but I think more small businesses are learning about it and implementing it. So again, we'd be happy to help anybody who would like to discuss this further. So next slide now, please.
Thank you, Laura.
Sure. All right, so since it is tax season, just some general tax planning ideas. We should all be contributing the maximum that we can to our IRAs, 401ks, and pension plans. And while you can't go back for 2024 to contribute the max for 401ks or pensions, other than whatever your employer decides to do in terms of profit sharing or matches, you can contribute if you're eligible to IRAs still for 2024. Under the Secure Act, required minimum distributions must begin starting at age 73 or age 75 if you're born in 1960 or later. You might recall in the past that was at 70 and a half, so that's a pretty big jump. And if you are turning 73 this year, your first RMD would have to be by April 1st of next year, so April 1st of 2026. And then you'd have to take your second one by December 31st, 2026. So usually we advise our clients to do the first distribution. Again, if you're turning 73 this year, do your first distribution this year and then your second one in 2026. So you're not doubling up. Because for one thing, you might jump tax brackets by doubling up. And also, if you are under Medicare, you have to be concerned about higher Medicare premiums. So IRMA is the income related monthly adjustment amount, that if your income exceeds certain thresholds, your Medicare Part B and D premiums increase, and it can be pretty substantial increases. So that's something you want to consider when you're looking at your income and your RMDs. One way to lower your adjusted gross income, even though you're required to take RMDs, is by making qualified charitable distributions, QCDs. So if you're 70 and a half or older, you can distribute up to $108,000 per year for this year directly from your IRA to qualified charities, which counts towards your RMD. So let's just say your RMD was $35,000. You could give that $35,000 directly to charity. You wouldn't have to pick it up on your tax return. And at the same time, then you've saved cash in your investment account that you don't have to, that you might have used for those same charities, but it's a very tax efficient way to do charitable contributions. Next slide, please. So as I mentioned, we still have time for IRAs. If you're eligible, the Roth IRA contribution is a great way to go. You still can make that for 2024. And the limit for 2024 and 2025 is the same. So 7,000 for those of us under 50, 8,000 for those of over 50. It is limited to your earned income or the annual limit. The benefits of Roth IRAs, which as tax people we love, it grows tax-free. The contributions can be withdrawn with no penalty or tax at any age. But if you want to not have the income taxed, you want qualified distributions, which can be made after age 59 and a half after 5 years. The 5 years starts when the account is first opened. It doesn't, so if you make your first contribution, then the 5 year starts. It's not, each contribution doesn't have 5 years, which is great. Also, if you become disabled, or if you're a young person, or maybe even an older person buying or rebuilding a first home, you can pull out $10,000 without penalty or tax. And then, of course, when you pass away, your beneficiaries can make qualified distributions after your death. Okay, next slide, please. One thing that I really encourage I could say my employees, but I meant my employees and my clients to do is to fund Roth IRAs for their children and grandchildren. And my children have had Roth IRAs since my son started working at Boy Scout camp at age 15. So it's a great way to, first of all, take money out of your estate, teach good financial habits, and encourage savings for retirements. And my dad actually has done that for his grandchildren also, because he wants them to learn about investing. And also, when you start young, you have an extended time for compounding of interest. And we know the power of compounding is great in terms of increasing your wealth. So remember, just a reminder again that you have to have earned income to make IRA or Roth IRA contributions. So for grandchildren or children, you need to look at their W-2 and see what their earned income is. And again, the 2024 contribution must be made by 4/15/2025. Now, depending on your AGI, you may not qualify for a Roth IRA. And the limitation for 2024 starts for single people at 146,000 of AGI and for joint at 230,000. So if you can't qualify for a regular Roth, you can do what we call a backdoor Roth IRA. And we have helped our clients with this many a time too, where you set up a non-deductible IRA account, contribute to it, wait a bit. There's not great guidance on this, so it's kind of a judgment call. But anyway, convert that in non-deductible IRA to a Roth. And then on conversion, you're only taxed on any earnings in the non-deductible IRA. This is assuming that you don't have any other IRA accounts. So typically you leave that initial contribution to the non-deductible in cash, so that by the time you contribute, there's very little income that you have to pick up on your tax return. Okay, next slide, please. Another thing that our wealth team helps people with is looking at Roth IRA conversions. This is typically looked at probably more when people are close to retirement or in retirement, because it would be best when your income is lower. But when you look at a Roth conversion, you have to consider your present and future tax rates, the impact on Medicare, which I mentioned earlier. You know, if you have higher income, it will cause your Medicare premiums to be higher. Federal and state tax considerations. For example, if you're moving to a state that doesn't have income tax like Florida, which I'm sitting in right now, it would make sense to wait to convert. If you were converting from an Ohio resident to a Florida resident, you would want to wait possibly until you were a Florida resident. So again, like I said, converting after when your income is lower makes sense. We have great sophisticated financial planning software to assist our clients in evaluating the impacts of Roth conversion on their tax and financial outlook. And one other thing I just wanted to mention from a wealth perspective, in general, you want to invest your tax inefficient assets like fixed income and alternatives in your regular IRA accounts, and invest equities and other growth assets in your Roth IRA and your non-tax deferred investment accounts.
That's a lot of great advice there, Laura, and thanks for letting Jim and I know that you were in Florida. Jim, you're not in Florida. I'm not in Florida, but you know, it's
No,
But it's warmer there, isn't it, than it was? I thought the temperature's gotten better.
you know,
below zero last week. It's warmed up a little bit though. So
it's
Right.
okay. All right. Well, we're going to move
All
on
right.
to couple of state tax points here, Laura. Take it away.
Right. Okay. So as Jim mentioned, currently the exemption is about $4 million. It has doubled under
14.
TCJM. 14 million. Yeah, what did I say? Sorry. 14 million. Thank you, Jim, for correcting me. Which would be about 28 million for couples. And of course, he mentioned also that Trump has promised to extend these. If not, the exemption would be cut in half, which would be estimated to be between $6 to $7 million. And that would mean estates that are greater than the exemption amount are taxed at 40%. So there was a lot of speculation last year and a lot of planning where people were using up their exemptions, and the IRS did state that there would be no clawback for gifts made prior to the sunset that are more than the future lower exemption. So if you had used up all your 14 million and it went down to 7, for example, you won't have to be taxed on that excess 7. Okay, next slide, please. And again, as Jim mentioned, there is a proposal in the Senate that was supported by 46 senators to repeal the death or estate tax. And this was prompted by a desire to protect family farms, ranches, and family businesses, because small business have a lot of value on paper, but they usually have limited cash because they're reinvesting in their business and trying to grow their business. And so sometimes when the owner of a family business dies, their heirs have to sell the farm or the business to be able to pay their estate taxes. So there was a similar bill also introduced in the House, and there's a lot of support by Republican leadership for this repeal, so it might result in a carve out for small businesses and farms. So this is considered a very turbulent year for estate tax policy because we don't know what's going to happen. If you think you're going to have a taxable estate, or maybe just because you want to benefit your family members while you're alive versus when you are deceased, a good idea is to give annual gift exemption gifts, exclusion, it actually should have been the word, annual exclusion gifts to family members. That limit is $19,000 per family member. If you are married, you could give $38,000 to a son or daughter. One thing to point out is that tuition and medical expenses paid directly to the providers are not considered annual exclusion gifts. So I have a client whose sister has been diagnosed with cancer, and she was telling me about this, and knowing how generous that client was about to her family. I mentioned about she could pay her sister's medical bills directly to the hospital or to the doctor, and she was thrilled to get that advice, to know that she could help her sister in her time of need. So it's a good time to be looking at your current plan to determine if it's achieving your goals, especially if it's 5 to 10 years old. And I would do it sooner than later, because estate planning attorneys are going to be very busy if we don't see a change in the tax law, especially at the end of the year. Another way to lower your estate is considering Roth IRA conversions, which I mentioned before, and then also looking at other forms of estate planning like SPLATs, which are spousal lifetime access trusts, which we set up a trust to benefit your spouse with your heirs as beneficiaries. And I actually have a client where we have set up the SLAT. We're opening the investment account right now. And the idea is that if we don't see a change, an extension of the lifetime exemption, that we're going to implement the SLAT before year end. So again, our wealth and estate planning and trust group can help you with reviewing your plan and help you and work with your attorneys on that. And then finally, one of my passions is charitable giving, and helping my clients who are charitable minded look at how to implement charitable giving in their either lifetime or estate plan, setting up donor advised funds where you can contribute appreciated stock or using the QCDs from IRAs. But if you're charitable minded, the best assets to contribute to charity at death are those that generate ordinary income, what we called income in respect of decedent assets, because your beneficiaries would have to pay tax at ordinary rates when they inherit those. So the best practice is to use the beneficiary form and directly designate charities as beneficiaries for your IRA and annuities, to be able to keep those distributions out of your estate and also avoid having to report them on a trust or estate income tax return. With that, I'm going to turn it over to Tom.
Thanks, Laura. That was terrific. And, there's just the devil's in the details on some of these individual planning topics. So thanks for all that. I think everybody can appreciate for their own situation. Some of those things will definitely apply. So, and I think everybody can see the sort of the interaction between our wealth management team and the tax team, and to try to really come up with the best move year to year based on the client situation. So thanks for all those little case studies. So there's a couple things going on in Washington right now. You might have heard about some of those if you're reading the newspaper or following the news feed. But so IRS development specifically, we'll talk about how that might affect us as taxpayers and, of course, as practitioners. So workforce reduction plan was implemented by the new President Trump. 2.3 million federal workers, which I've heard. I think there's, I've heard the number, Jim. I can't remember what it is, how many total federal workers there are, but of that, about 75,000 that were of the 2.3 that were offered, 75,000 accepted the plan, and so that represents about 3% of the government workforce. The buyout plan allows federal workers to work through tomorrow, and then they go on paid leave for 8 months. So about 75,000 folks will take advantage of that after tomorrow. So, and then IRS workers that accepted the plan, they've got a deferred date to get through filing season of May 15. So, additionally, DOJ is working with all the federal agencies and work specifically with the IRS on the priority of examining fraud related to the earned income tax credit. Recent estimates of 15.9 billion of fraud in fiscal year 2024. GAO estimates 34% of the payments are improper. So another article, a couple of other talking points. Over the last 10 years, and this is inflation adjusted, so it's a little bit different math than what I showed you here. It's about $19 to $21 billion a year of improper payments is what estimates are and that equates for those folks that receive it about 1 to 2 billion in unpaid or underpaid tax for those per year for those 10 years. So, earned income tax credit is kind of a program that it's been well advertised. There's a lot of abuse of that. So, additionally, on January 20th, when President Trump was inaugurated, signed an executive order of a hiring freeze. And we can see here how it specifically impacted the IRS and the OMB plan. So there's specifically a lot of things going on there in the IRS with the hiring freeze. So the government order mandated federal workers to return to their duty station, so in office, with some limited exceptions. And so that's another change that President Trump implemented, which is, I'm sure, been hard for some workers. Additionally, last week, again with the IRS, implemented a significant workforce reduction. And we know that 6,000, maybe up to 7,500 IRS workers were terminated, were part of that. And they targeted up to about 16,000 what they call probationary employees, which are newer employees still in a quote unquote probationary period, generally those with less than 2 years of experience. And the cuts are going to affect, of course, those who didn't accept the buyout offer and not deemed essential for tax filing season. So mostly we believe, what we read is it's compliance personnel. We've seen some, situations, in our practice where that would hold up. So a lot of revenue agents that were new to the IRS are part of that 6,000 number. Additionally, you might have seen that there was some consideration of trying to send some of the criminal investigation agents from the IRS to help with border security operations. Don't really have an update on that. That was just another news point that we wanted to offer up. So then on February 11th, earlier this month, launched a workforce optimization initiative. Effectively enforced a hiring ratio of for every one person hired, four would have to exit the agency. So would not affect the IRS hiring freeze that's already in effect. So just lots of things involving personnel, federal employees, specifically the IRS. Lastly, again, the hits keep on coming for the IRS. There was a hearing. I think it was the same day this letter came out, but the letter and the hearing, I think, topic-wise, were similar. There's just some concerns about certain things that that Congress has noted: retaliation against IRS whistleblowers, taxpayer data security, and there's a data breach, as we all know, that occurred, and it's been well publicized by the contractor. An IRS contractor appears to be the main source of that breach. Lack of progress toward modernization and customer service. Specifically, the 1099-K reporting regime, technically was supposed to be implemented a couple of years ago and was deferred by the IRS and effectively changed by the IRS, which is contrary really to what the law said. So that was brought up, and then lack of action against tax-exempt entities engaged in anti-Semitism. So the IRS is just under a lot of fire right now, and of course some personnel losses as well. And then lastly, a couple notables. There is an IRS commissioner nominee. We haven't heard anything more about it since he was announced. There's not been a hearing scheduled to start its confirmation process, to my knowledge. And then the Commissioner Werfel resigned. Acting IRS Commissioner O'Donnell has also announced that he's retiring as of end of the day tomorrow. So Anyway, so a lot going on there. They've announced an interim leader. I think her name is it Kraus? I saw,
Yeah,
Jimmy. Yeah.
yeah, she was
So
the chief operating
yeah,
officer over now, so a lot of transition
yeah,
there.
yeah. So the question is, what's all this mean? And I use I tell a lot of folks that the IRS is pushing compliance down on the practitioner community more and more. And of course, with less people and more reporting regimes, more disclosure requirements, it is impacting the practitioners, the software we use, the amount of work we have to do to try to keep our clients in compliance. So and now with the personnel cuts, we can only speculate as to what this will mean for the remainder of the compliance season. So more on that as we watch this all unfold. Lastly, just a slide on tariffs. A lot of talk about tariffs. I was listening to radio on the way in, and it was notable that somebody said, President Trump sort of said that a little bit in jest, but it's telling that mentioned God, country, and tariffs in sort of a comment last week. And so, and the point of that was that he's using tariffs in a lot of ways to really set the policy for the country and try to he's using them as leverage, and he holds them in high regard. So we have to think about that for our businesses, for our clients, and how it might affect our clients. A couple things, talking points. If we see tariffs and there aren't good alternative sources of those products, we're probably going to see inflation in the pricing of some of our products, right? And we're going to, companies are going to pass those costs along. So might be a good time to look at LIFO again.
Yeah.
One of Jim Brandenburg's favorite topics, LIFO inventory, and he and I have
Pricing
talked many
up
times.
makes sense. Yeah.
And we've seen it. We saw it right in 2022 when we had high inflation. Saw a lot of LIFO strategies being implemented very effectively. The other thing is, and I certainly would defer to our colleagues in our international tax group. But I've talked to Elena Messina about that, who heads up our international tax group. The transfer pricing is another strategy, right? And so think about the price of those goods coming into the country, subject to tariff. Can those prices be adjusted to reduce the tariff? And is that within the boundaries of those rules? Is that a better strategy than paying and paying more tax, right? Paying more
Right.
tax potentially than paying the higher tariff. So those are things to look at. And I think we've got a poll question here. Jim, if you want to read that question to folks to see, let's get a feel for
We got to
tariffs
get
and how they.
we get it wrapped up here. Last question, last poll. Will the imposition of tariffs have an impact on your business? So you got the four
Yeah.
choice: significantly, moderately, or a little bit is the second one. No impact, and the last one is not applicable. So if you could respond to that quick. I know we've got a few minutes left here, and we'll try to get through the last section here. We'll get this poll wrapped up here. Significantly, about 20%, 40% for moderately. That's interesting. That's the highest. 20% for no impact, and then not applicable 20%. So that's good to
Yeah.
see that there's some impact.
Yeah,
And
it's good. Yeah, so some impact to everybody. It's good information. Thank you for that. Couple of last points here. The IRS has audited some of the largest partnerships in the country, and so there's some specific areas that they're focused on. And frankly, a lot of the legislation, Jim mentioned carried interest, but partnerships, big complex partnerships, there's the concept of basis shifting. One of the issues we've seen work its way through the courts several times here is whether limited partnerships are in fact limited partners are in fact limited and exempt from self-employment tax. So note that if you have that situation and you're a limited partner, you really need to pay attention to this. Talk to an advisor, but there's the IRS is really focused on that issue specifically. Lastly, a second to last here, beneficial ownership. The Corporate Transparency Act, many of you may be familiar with. Reporting deadline is now March 21, 2025, and that just happened this past week after a court case was settled, or a decision was made in a Texas court, I believe. And so there's also a House bill out there that the House passed unanimously to extend the effective date of the Corporate Transparency Act to the beginning of 2026, I believe. It was a unanimous vote by the House. The Senate has not taken it up. It is notable that the Trump administration is supportive of the Corporate Transparency Act. So we'll see where all that plays out. But there's a bill out there, and you could speculate that maybe this gets delayed or changed again. It's a roller coaster. Lastly, I'm sorry, I'm going to skip over R&D. There's some new reporting there. And lastly, I'll just tell you, there's this concept of wealth tax we've seen being kicked around in the last administration. It's a concept that's not going away, and we can see more states taking that up. Here you'll see the 5 states that have a wealth tax, and then we've got some states that have a proposed wealth tax. So anyway, keep an eye on those things. Stay close to your advisor and just understand the landscape, because it's ever changing out there. So I have gone 1 minute over, and I want to thank Laura and Jim for their great input here.
Happy to
And
help.
thank everyone. And note that at there will be a survey. Please take a moment, tell us how we did, tell us what information we can provide to you in the future, and look for additional information on this tax legislation as it evolves. So Jim, Laura, thank you very much.
Thanks, Tom. Thanks, Laura. Thank you, everyone.
Thank you. And we'll respond to the questions that were sent.
Yeah, thank you, Laura. Also. Yeah, exactly. Thank you. Have a great day, everyone.
Yep. Bye-bye.